Understanding market volatility is crucial to executing your trading strategy and ensuring you trade at the correct times for your personality profile. But keeping up with market trends and predicting volatility across all your favorite instruments is exceptionally challenging. This uncertainty was the motivation behind Autochartist developing the Volatility Analysis product. This tool provides you with valuable insights into the past volatility of an instrument so you can get a better idea of the personality of your instrument. It also gives you a realistic price region where you can expect to trade at certain times. How do we do it? Using over 6 months of historical data, we forecast the future volatility of any instrument based on past volatility for every day of the week and every hour of the day. These predictions are based on standard deviation and show that the probability of the price staying within the expected range is 68% or 1 standard deviation. We also provide a forward-looking price range movement analysis with insight into potential movements for the next 1, 4, and 24 hours. Expected volatility for every day of the week. This information looks at daily volatility levels in pips, giving you insights into the most and least volatile days of the week. While the differences in volatility at this level may not be as extreme as the hourly or future-looking graphs, it still provides traders with valuable insights into which days best suit their trading style. Expected volatility for every hour of the day. These movements look at the usual volatility of the selected instrument at all hours of a typical trading day. Again, the range here is measured in pip movement rather than price. This information is helpful as it gives you insight into when your instrument experiences the most and least volatility throughout a trading day. Having this knowledge is vital when deciding when to enter or exit trades in line with your personality profile. For those suited to high-risk and high-volatility trading, you can focus your activity around the most volatile hours, which usually fall at the open of the London and New York markets. Those with a more conservative trading style can look for periods where the market is more predictable to focus their efforts. Price range forecast. This is shown by a range of potential movement for the next 1 hour, 4 hours, and 24 hours. As one would expect, as the time frame increases, the possible movement size also increases. The first range represents 1 hour and shows the smallest potential movement. The largest of the bars represents a full 24-hour day and therefore has the most extensive possible range of movement. For each of these ranges, there is a 68% likelihood that the price will remain within that range. With this knowledge at your disposal, you can make a more informed decision on where to place your stop loss and take profit levels according to what you want out of your trade. For example, if you wish to increase the chances of staying in a trade longer than 24 hours, you can set your stop loss outside the daily margin. On the other hand, if you want to be out of a trade before the 24-hour mark, you know you should set your take profit within the daily margin. When trading, it is essential to remember that you cannot use these insights in isolation. Even the slightest change in a seemingly unrelated market can influence your instruments. Therefore, it is crucial that traders take a holistic approach and always consider factors such as world news when deciding on the best time to trade.